You know, on Tuesdays, about this time, we talked to one of the guys at Fagan Associates about money stuff, you know, so you can kind of take the mystery out of investing. And today we get Dennis on the line, and he's going to tell us a little bit about the truths of investing. Saw this one, Dennis. It really caught my eye. Compound interest. We've heard about that. It says it's amazing, but it takes time. Can you expand on that?
It does. I think, you know, when you think of interest rates today at 1%, a lot of investors, especially when the market is volatile, like the linear move, meaning that they get a little bit of interest every month. And there's this rule of 72, which means you take the numbers, you take the percentage of interest, divide it into 72, and that's how many years it takes for your money to double. So if interest rates were 6%, it would take 12 years, and you get a bit of interest every month, and that's not a bad thing. But with interest rates at 1%, it takes 72 years. So compound interest is amazing, but at these interest rates, it takes a heck of a long time for it to work. And I think that's what investors are finding out now, is that as they have money sitting in the bank, it's really not earning a lot, and that's why they're assuming more risk in the market. So it works well.
But just not right now.
Exactly, but just not right now, for sure.
Talking to Dennis Fagan at Fagan Associates. So, Dennis, based on that, then, you know, the market in the short term will see some pretty big fluctuations, but not so over the long term, right?
It's very predictable over the long term, but over the short term, it's very unpredictable. It can be very volatile. And so the average investor spends too much time worrying about the day-to-day movements in the market rather than just the long-term benefits. In fact, Fidelity did a study a few years ago which showed that the people who didn't even know they had accounts at Fidelity were the ones that did the best. so that was kind of interesting.
Oh, my gosh, that is pretty awesome.
Yeah.
Another thing that caught my eye, Dennis, was any investment strategy with high expected returns should come with the expectation of losses. Can you talk more about that?
Exactly. And the market tends to go down every 2 or 3 years by 20 or 30%. The average bear market's about a year long, but the average bull market's about 5 years long, and the magnitude of the gains are about 5 times the losses in a bear market. However, like anything else in life, when you're experiencing fear, experiencing losses, that attitude of, hey, I have to protect myself takes over, and you tend to become too conservative at the wrong time and probably too aggressive or risky at the wrong time as well when the market moves up. So you have to recognize that investing, if you want to get 7 or 8% on the average over a full economic cycle, you have to recognize that you're going to lose money now and then, or else you'd get the 1% like in the bank. So losses come with the territory. It's part of investing, and how you respond to those losses really determines your overall returns that you get. You know, do you sell at the bottom and say that you never make money in the market, or do you realize that buying low is selling and selling high is kind of the trick, and you take advantage of those dips?
So do you see a lot of people, Dennis, that will, you know, when things are going bad, they'll just say, oh, I got to sell, when it's, you know, probably the wrong time to do that?
I do. That's part of our job, you know. Every bull market and bear market has a catalyst. Unfortunately, you can't see them until they're in hindsight. So with COVID-19 in March, the market went down 30% in like a month, and everybody freaked out because they had never seen that catalyst before. But there's a lot of catalysts that you never see before. It's just a reason for the market to go down. So we do get a lot of calls, but a lot of our job, depending upon the volatility, is to make sure that people stay the course.
Sounds good. I saw this other one that really caught my eye, too. It says, watching your friends get rich makes it difficult to stick to a sound investment plan.
Think if you're in Vegas and your buddy's making tons of money, what are you going to do? You're going to think, I'm going to bet a little more, I'm going to take a little more risk. And typically that doesn't work that well. The market's the same way. You know, you get a lot of people over the short term making money just on speculative bets because the market's going only one way since the bottom of since COVID in March. So it's difficult. It's like a vice.
Stick to the plan.
Exactly. It's hard. It's like I said, it's like diet and exercising. You just got to stick to the plan the majority of the time.
We've been talking to Dennis Fagan. Now, you're the kind of guy that is going to help people stick to those plans. Tell us where people can find you.
Give us a call, 279-1044, area code 518. Check us out on the web at FaganAsset.com, or like us on Facebook. We're there to help.
All right, Dennis, I really appreciate your insight on this stuff because, I mean, you're the kind of guy that I think we all need just to keep us on course, because otherwise we're going to make some bad decisions.
Appreciate it, Randy. Take care. Have a good week.
All right, you too. Bye-bye.